Morning, everyone. Thank you for joining us for our inaugural Spotlight on Financial Services series, where industry experts are discussing the latest issues facing the sector. I'm Chris Brown, and I'm a partner in the corporate and commercial section at Hall & Wilcox here in Sydney, and I specialise, amongst other things, in M&A in the finance and insurance sectors. So that's funds, advice, insurance, deals. Today we're joined by Nelson Lamb, partner at Berkshire Global Advisors, funds. See what I'm about to do. Paul Aspro, who's the MD of PSK Private Wealth Advice. David Hosking, who's the CEO of PSC Insurance Group, Insurance. And Anthony Brasher, who's co-founder and partner at Barrenjoey, Deals. I think you saw what I did there. First of all, I'd like to begin by acknowledging the Gadigal people of the Eora Nation, traditional custodians of the land we're gathered on today. I recognise their continuing connection to land, waters and culture, and I pay my respects to their elders past, present and emerging, and to all First Nation peoples joining us today. So, let's start. Looking back over the last 2 decades, the Australian finance sector has been transformed by a series of seismic events. First, the GFC saw the retreat of major overseas banks from Australia as the global banking system contracted. Secondly, new capital requirements affecting banks resulted in the wholesale divestment of capital-intensive businesses, life and general insurers, often to large overseas groups better equipped to take a longer term and less constrained view. Thirdly, adding to the forced reorganisation of capital priorities, legal and regulatory reforms and a swinging Royal Commission were the final catalyst for each of the major banks to divest their wealth management arms if they hadn't done so already. And finally, post-pandemic economic conditions and geopolitical tensions have interrupted the free flow of capital, which has helped to keep the sector and deal activity buoyant for the best part of a decade. So structural change is often a catalyst for transactional activity. But after an intense decade of deals, one wonders what's next. Will we see a period of relative calm during which companies reposition and focus more on engaging with customers in a post-pandemic digital world? Will the banks continue, as they have done of late, to duke it out over market share in their traditional areas of operation, for instance, mortgages? Although I note from recent results announcements that a truce of some description has been declared in that so-called mortgage war. Or can we expect to see another wave of transactions? As an M&A practitioner, and everyone else in this panel would certainly hope so, I'm sure. So this all begs the question, financial services and financial services M&A, where to from here? To help answer these questions, we've assembled a very distinguished panel of guests, each of whom is fair to say is a leading light in their respective fields. I'm going to take a seat and I'm going to ask the panel to introduce themselves. Do you want to? I think I got that right. So, who are you? Who do you represent? And give us a fun fact that we wouldn't necessarily find out from reading your website bio. Nelson Lamb.
Okay. Firstly, thank you, Chris, for the invitation and to Fox for hosting. Nelson Lamb. I'm the Asia Pacific partner for Berkshire Global Advisors, not related to Berkshire Hathaway. We specialize in M&A in financial services sectors, and within that, wealth management, funds management, and that whole value chain. One fun fact, I love doing Tough Mudder. They've been away from Australia for 3 years. They finally bring it back this year. So I'm looking forward to doing that in October. If anyone wants to join, then let me know. Yeah.
I'm David Hosking. I'm Chief Executive Officer of PSC Australia, New Zealand and Hong Kong. Just a quick bit about PSC. We're a Australian-owned, Australian-listed general insurance broking firm. Started 17 years ago and now offices in six countries around the world. my job there is pretty simple, actually. All I have to do is help our leaders grow their business. Background has always been in insurance, or started off many, many years ago in chartered accounting, but probably the last 25, 30 years in general insurance, and mainly on the underwriting side, and in the last sort of few years on the distribution side in broking. Fun fact, I don't know if it's fun, a bit like yours. Something I got into a few years ago was open water swimming. I quite liked swimming when I was a kid, sort of reacquainted with it a few years ago, and now can't see myself not swimming 3-4 times a week to, 365 days a year kind of thing, for a couple of Ks. So that's my fun fact.
Yeah, thank you, Chris. And it's wonderful to be here. Thank you for the invitation. My name's Paul Aspros. I'm the Managing Director at PSK Private Wealth. We're a firm that dates back to 1969, was the original founder of our business. PSK became PSK as we know it today in about 1997, so about 25 or 6 years ago. That's when I joined PSK. I joined PSK as an advisor, an equity partner and an advisor in the business, and 10 years ago became the managing director. On the day that I joined the business, it was a little group of 8 of us working out of an office in Sydney. And then we fast forward 26, 27 years, and we're now a group of 300 people across 12 locations around the country. My little kind of fun fact is I'm an absolute sports tragic. If there's a sporting event anywhere, whether it's in the world or whether it's down the road or across the other side of Sydney, whether it's professional sport or friends of mine, kids playing, I absolutely can't wait to get there. So I've been to kind of most of the World Cups ever since Australia started qualifying. But as I said, I get just as much enjoyment out of going down the road and watching one of my mates' kids sort of kick a ball around. So yeah, that's me.
Yeah, thanks, Paul. So my name's Anthony Brasher. I work at a firm called Barrenjoey, who only been around for 2 years rather than 50. Yeah, so we're a full service investment bank. Started a couple of years ago, primarily from a lot of people from other investment banks in Australia. I sit in the investment banking side or private side of Barrenjoey and run their financial services and technology business. Primarily advising banks and insurers and everything financial in Australia. Yeah, I think it's a great initiative today and obviously very topical. Fun fact, yeah, I'm also a bit of a sports nut. I'm also involved in sports administration, so I'm the deputy chair of Baseball Australia, as well as doing my day job.
Thanks, guys. What a brilliant panel. Nelson, is there any truth in the rumour that you make new employees at Berkshire participate in Tough Mudder? You don't need to answer that question.
I like going to the gym, so yeah, open invitation.
They're prime candidates. All right, and David, to your point about open water swimming, it's a bit swimming. It's a bit chilly at the moment, so maybe we'll start with an icebreaker for you. And yeah, they'll keep coming. I've been practicing my dad jokes. So, I mean, I want to target this question to you and Paul in particular. To what extent has M&A played a role in your business? How do you go about, or how have you gone about doing it, and how's it worked out for you? Maybe start with you, David.
M&A has been absolutely integral in our business. The founders of PSC, John and Paul Dwyer and Brian Austin, had a very clear plan and a very clear game plan that they set in motion probably 15, 16 years ago. Started with one acquisition in South Melbourne, and the first year their reported results was 70,000 revenue. So 50 or so acquisitions later, it's 330 million in revenue. We transact, so that's revenue to the PSC group. We transact through put about 2.5 billion in gross written premium. So that's how much we handle. 300,000 clients, managing about 450,000 policies for them, and about 1,000 people worldwide. So M&A has been critical. The M&A strategy is actually pretty simple for us, and it's quite disciplined, and it's something that we haven't departed within 17 years. And in that 17 years, you've seen all sorts of cycles, both M&A, interest rates, capital, etc. It's been pretty simple. We like buying really good businesses that have got good clients and people. The rest we can work with. We're pretty clear about what multiples we will and won't pay. We see no value in paying really big multiples. We just see that as a dollar swap. You know, it's great that we can meet an owner's expectation at 10 or 12 times earnings, but it seems a bit ridiculous if you can't do much more with that asset. And it is, as we like to call it, it's a brick by brick M&A strategy. And we're comfortable buying small private companies where maybe the founder is at the end of the road and looking for a sort of an orderly exit, right through to larger sort of businesses in London, such as Paragon, which was quite a big, well-known, notable wholesale broker. So as I say, it's very brick by brick, transaction by transaction. We look at it all, and if we think it fits our people and our business, we take it and obviously try to do those basic improvements that we can to just get that extra bit of margin.
Terrific. And Paul, does that resonate with you? How does PSK run things?
Yeah, very much so. I think probably the only bit of difference is where David mentioned that theirs was a very, very deliberate, structured plan around M&A. When we first did our first ever deal, we had no plan to do any acquisitions. And since 97, we're now 23 acquisitions in. And at some point along the way, it did become part of our strategic objectives and part of the important part of how we decided to grow the business. So when we started in 97, historically our M&A has escalated at a time when there's been disruption, whether regulatory or otherwise in our industry. In 97, excuse me, we had, back in the day, you had two big life insurance businesses, AMP, National Mutual, where they would house all of their advisors. So unlike today, where advisors have individual offices that they work from, back in the day, these two big companies would house all of their advisors, agents in their offices. And in about 96, they decided to close all those down. So there was thousands of advisors across the country that were displaced. So we opened up our office. As I said, there was about eight of us on the day. And just by chance, there were so many advisors that we knew that were looking for a home, that we decided that we wouldn't just provide people with a home as the life officers did. What we would do is we would take equity in those firms as they joined us, in those individual practices. And we would help build their businesses, and we would help them scale their businesses. We would help them become more efficient. And our share in the value that we were creating came through the equity that we owned. So we stumbled across essentially M&A. And then at some point along the way, as I said, then it became something that we thought about a little bit more strategically. Today, for example, to give you a rough idea, in the advice industry, an average advisor might look after 100 clients. And if one of your objectives is to help advisors become more efficient, to help them look after more revenue, your target might be to help an advisor get from 100 clients to 150. And there's two ways, obviously you can do that. You can do that organically, or you can do that through acquisition. And I think for us, we purposely made a clear decision that we wanted to do both. But to get even a very good advisor from 100 to 150 clients is something that could take a good advisor 2 or 3 years, and a not so good advisor a lot of years to get 50 clients. So different advisors need different types of assistance. And I think the misnomer or the myth in our industry is that organic growth is cheaper than acquisition. And to David's point, if you actually are very, very disciplined in the price that you pay and in the quality of the acquisitions, if it's going to take you 5 or 6 or 7 years to get an advisor from 100 to 150 clients, or it takes you 1 day to go and buy 50 clients, if you buy the right clients from the right people, in many, many ways, you can build a hypothesis that says acquiring is actually cheaper. So we made a very, very clear decision, probably 10 years ago now, that we were going to try and do both, and we weren't going to concentrate on one or the other.
Thanks, Paul. That's really interesting. So, I mean, you're all M&A people, it's fair to say, which is why you're here. David and Paul, you've got it embedded in your businesses, as we just heard, with your different, but maybe sort of coming together approaches to M&A and discipline and the drivers. Nelson and Anthony, you know, your corporate advisors, your corporate finance specialists. How have deals changed in the last decade? Just want to know from the panel, who's doing deals now? How are they being done? And which sectors and thematics are at play? Sort of, you know, taking a historical view and bringing it up to date. I'll maybe start with Anthony, bring you in.
Yeah, sure, thanks. Yeah, so I think you mentioned at the start that there was some pretty strong themes coming out post GFC in the Australian financial services market. We did see regulation really kicking off a lot of the activity that we've seen over the past 10 years, with the major banks selling out of wealth management, asset management advice. And that's primarily at the end of that period. I think Westpac really the only one with an asset left. So that, I guess, that thematic is towards the end of the thematic. What we've seen in other sectors globally, not just in Australia, is the globalization of both life insurance, general insurance, and asset management. We're continuing to see that in Australia. Life insurance in Australia is now primarily owned by global Japanese or European, US companies. But asset management hasn't quite got that far yet, and we still see a lot of activity in that asset management space. And you would have read, well, there's been a number of transactions, including the Pendal Perpetual one that closed recently. But we see a lot of conversations continuing where asset managers are looking for diversification and scale, particularly as margins get eroded through passive investment strategies, etc. So I see that thematic continuing to play out. I guess the other thing that I'm expecting over the next couple of years is the major banks to start doing buy-side M&A again. It's probably a little bit too early for them to start buying wealth, but maybe not too far away again. But all of the major banks in Australia and the regional banks have realised that they've got businesses that are primarily a commodity now, which is Australian mortgages, and they need either high margin businesses or fee income in order to meet their cost of capital. So they're all trying to be quite innovative to either buy customer platforms and other types of revenue to diversify away from what is a very competitive mortgage market at the moment. So yeah, I really expect that to continue.
Great. Nelson, over to you. I think there's a few points made by Anthony there that you can perhaps identify with around asset management.
Yeah, no, I certainly agree with Anthony on many of those front. Just picking up on the cross-border globalization point, I think certainly over the last 10 years, probably 3 observations I will make. One, transaction is actually getting a lot more sophisticated in M&A, particularly as it comes to due diligence. I think that is partly informed by a lot of regulatory changes and regulatory standard. So we're finding buyers are definitely a lot more thorough in their due diligence approach and what they're looking for. So I think our clients are having to really either be prepared for, particularly if you're dealing with US buyers. They are very US buyers, and they are a lot heavy on technology due diligence. What is your cybersecurity and things like that. Whereas say you're dealing with a European buyer, ESG is a major theme in M&A. And we'll probably come back to that later on. I think globalization of capital is something we've seen over the last decade as well, which plays well to certain sectors globalizing as well. I think capital is a lot more global and mobilizing. And we've certainly seen that in wealth management in Australia, where we've seen a lot of US capital coming into the country as well as European capital. So I think, we are seeing capital moving into Australia, into the region. And as Anthony mentioned, the Japanese have moved back into the country in financial services again. And I think technology over the last decade, in terms of involving M&A, it's going to be interesting, very interesting how that's going to play out going forward. But once upon a time, no one here would have thought you could do a deal without shaking the hand of the other guy. But I'm sure a lot of us did deals during COVID period where
A lot of deals.
where the buyers and sellers never actually were in the same room, haven't shaken hand, and the deal was consummated. So, I think that's a good lead indicator of, what can be possible when once upon a time that people would say, well, I'll never do a deal with you if I haven't shaken your hand or share a meal. Yeah. Yeah. So, so I think, that's a watershed moment in some ways. So I think,
Paul, yeah, sorry, Alison. Okay. Paul, just quickly, in wealth, who is doing deals? How are they doing them? And what are the sort of major focal points for them, or themes, do you think?
So who's doing deals is changed over the years. Deals in the small cottage advice industry essentially would only ever be succession plays. So deals would only happen when someone was retiring. It was a trigger event that meant there was a deal to be done. Today, deals are being done on the basis of businesses trying to improve themselves. So the basis on which two businesses might look at either merging or one business acquiring part of or all of another firm, essentially today may still have some succession inbuilt somewhere, but it could be further down the track. Today, most of the deals are done, or the majority of deals are done on the basis that everybody's looking for that holy grail of trying to be better, trying to be more efficient, trying to improve the proposition to the client. And if I think about the sweet spot, depending on who the acquirer is, on the far left-hand side, you have the very, very boutique, small one-man, two-man, two-person, three-person, five-staff operation, very boutique, very, very particular, very, very client-centric, specific, tailor-made offer. And on the far right-hand side, you have a few very, very large, in our industry, advice industry, large businesses. I think the boutique practices, they're in a very, very good position. They've got very strong client propositions, generally very, very high margins. And they will survive and they will probably thrive in an environment where there's less and less advisors and more clients looking for a home. I think where we're seeing a lot of activity in our industry, in our sector, is in between those two. So where we have firms that are 15 or 20 people, 30 people, and they're forever running, they're running every day. They're trying to work out how they can get from 25 people to 50 people or to on the basis that as they get bigger, they'll be able to do more things. Scale will give them some advantages. And I think they're the people that are finding it the hardest right now to swim against the tide. So the boutique, small operator, they're happy in their own world. They're providing really, really good, outstanding services to clients. The businesses at the far right probably have enough capital and enough people and enough resources available to them to innovate and to build some of the efficiencies. And if I think about where we were 15 years ago, we were kind of in that little group that was trying to sort of get to the other end. And I think they're the most troubled. So I think where we're seeing a lot of activity is in that middle group, those businesses that are trying to improve themselves, that are, waking up to the fact that for them to get to the other end, it's probably a 5-year journey. Whereas they can actually get there a lot quicker if they can find two of them to do it together, or if they can tack onto it to a larger firm.
Yeah, great, interesting. David, just finally to you, I mean, I'd be interested in your perspective as someone who was working for large insurer or large insurers and now is sort of, I was thinking about using the metaphor of gamekeeper turned poacher, but that would probably be a bit impertinent. So just strike that from the record. But what are you seeing? Who, other than yourself, who's doing deals? How are they doing them? And what are the major themes?
So I'll start on the insurance side. Insurance, probably where Anthony was going earlier, insurance went through a really big surge of M&A about 15 or so years ago, probably off the back of regulation. People, no one in this room be, old enough to remember the ISC that became APRA, and that put in some pretty strict capital controls. And I think a lot of organisations, particularly offshore ones like Aviva and Royal Sun Alliance, question whether they wanted to be there. And it just led a lot of aggregation and scale. Technology was getting important, brand strength was getting important. So scale became a big thing. And that's when, you saw organisations like IAG and Suncorp go from sort of middling to Allianz, QBE, the large, big insurers that you hear. And then there probably everything that kind of could get bought of scale was bought and aggregated. And probably over the last couple of years, the only bigger deals in that space has been Westpac and Commonwealth Bank, each handing in their sort of general insurance business. And, they wouldn't, I'd imagine, I know I was leaving Allianz when they acquired Westpac, and there was no shortage of buyers at that time. And I'm sure the same as with Commonwealth into Hollard. So on the general side, I think, that scale's been taken sort of into account. On the broking side, it's very similar to the advice model. You're just seeing a lot of great businesses being built up from, really capable. So I sort of observed over the time, in general insurance broking, if you want to be successful and build a business, you've got to be a great broker, really client focused, understand the technical parts of the role. You've also got to be a pretty strong business person as well. You're not going to survive. I've seen great brokers work their butts off for 20 years and turn around and barely have enough to buy a weekender when they retire, kind of thing, And I've seen some who are terrific business people, they just can't retain clients because they just don't understand the nuance of broking. You really need the best of both. But there's a sort of an end of life for these guys, and some of them probably don't know what to do next. So and I've put PSC into this category. Companies that are very comfortable aggregating businesses, they're our target clients. So in the Australian market, obviously the PSC group would be one. AUB, Steadfast, so they're the three major listed guys. Probably over the last couple of years, what I've seen in broking really happening is an organisation called Ardona. Now, I will admit, I'd never heard of them until 2 years ago, but now they're buying up quite a lot of brokerages around Australia. Howden, private company, but some pretty strong private investors into them are really in this part of the market. Gallagher, big US firm, AJ Gallagher, very, very big US firm acquiring. So probably the international ones are Ardona, Howden and Gallagher, who are big on the M&A front. And then domestically, obviously ourselves and the AUB group. So, and I think the theme there is that all of them are probably looking for very similar businesses, sort of what I'd call end of life cycle, and what the principal wants to do with the business next is probably where you're seeing then. So there's a lot of aggregation in insurance broking. Just the size of the deals, they get dwarfed by the amounts of the general insurers, because general insurers have to pay for such big balance sheets as well, which kind of gets factored into the headline price. But I am seeing it's quite a fascinating time being in general insurance broking, because you're seeing a lot more of that aggregation that I saw a lot of sort of 15 odd years ago when I was on the underwriting side.
Yeah, great. Okay. I want to talk next about legal and regulatory reform. I mean, obviously half the people in this room pin their ears back when the laws change, because we have to advise clients on those laws, and very often it's a catalyst for deals. So that's where I come in with my team, or there's a dispute because someone hasn't complied with the new law. Unfortunately, well, it's good for us, but unfortunately, people operating in the real economy have to live with rapidly changing landscape and operating conditions. Probably fair to say that over the last 15 years or so, the most fundamental reforms stemmed from the GFC and what the Treasury wonks in the US promulgated and in other major banking jurisdictions and pushed over and shared with the rest of the world. But obviously in Australia, there'd been some fairly significant non-banking reforms. I'm thinking of the future of financial advice. I'm thinking of what has come down the pipe or is yet to come down the pipe from the Royal Commission. And obviously there's the QAR, maybe or maybe not will result in reforms. And I promise you, Paul, I won't get into too much detail on QAR. But what I want to know from the panel is, do we think that the current government, who's just handed down that second budget a couple of days ago, have a sort of materially reforming agenda which could impact transactions or impact the operating landscape, which could in turn result in transactions? And maybe I'll go to David first. I mean, I think it's probably fair to say insurance has remained, other than sort of prudential regulation, have remained relatively unscathed, fortunately, from all the FOFA and Royal Commission and what have you. Commissions, I think, are agreed still to be the best and perhaps the only viable way to pay for retail insurance. But what are you expecting from this government? Or I guess, what are you expecting from the regulator which could impact your sector?
I think if you'd asked me a year ago, the quality of advice was the sort of the only, the subject that feels like a lifetime ago, the Hayne Royal Commission, but there was only one determination he couldn't quite wrap his head around, and that should commission be retained inside product? And is there a real systemic issue with advice, not just in general insurance, life insurance, financial advice, etc.? He could kind of get some case studies, but he couldn't quite work out were these just a few rogue players or is there something really fundamentally systemic here? So he kicked it down the road, and the quality of advice review, which Michelle Levy headed up this time last year, sort of became, this time last year, I would have thought there's a real potential that this could shake it up. This could tend to go in a direction where some people would just go, large brokers and small would go, it's just too hard. I really don't want to have to go out, and every time I'm trying to tell my client, it's so hard to win a client. And then by the time you've won them, to actually sit down and spend, half a day with them to step through everything carefully. When all they're thinking is that I've just built a new factory. Can you just go insure it for me? I've just sort of, I put on 200 more workers. Can you just sort of work out my workers comp for me? And I think invariably people that do these reviews have never actually lived in the real world, probably had, and I'll be quite blunt, and I've worked with ASIC and APRA and I love them all, and they all come from private schools, from highly educated backgrounds and, professional parents. They've never actually seen what an SME goes through. So I could see some early days sort of thinking coming about, hang on, if there's less than 20 employees in a business, you then need to go all this. Now, the reality is if you go out and start to talk to most SMEs in Australia, how many workers have you got? They start to get suspicious. Why do I need to know? So quality advice review, I thought, could go down a direction that could just lead a lot of brokers to go, this is all too hard, or you know what, I'm happy to stay in the business, but I don't want to be an owner of it, etc. Pleasingly, Michelle Levy, who I actually have met a couple of times, is a really sensible person, because what she did, which was different that I hadn't seen from many people that do this, is she actually stepped through, okay, this is what people are saying we should ban, but what's the alternative look like? So she started to role play what the alternatives look like. And what she ended up with in general insurance and life insurance is that if you take commission outside of the product, it could actually have a really catastrophic effect, because a lot of clients don't really care about the commission being in the product. They get it. They just assume it. In fact, they're saying, the reason they're just thinking, I'm paying you a commission because you're probably going to get a better deal than I can. So she stepped through all that. So her findings that were, socialized, 8 months ago, sort of found it in about October, November, plenty of time for consultation. By that stage, there was a new treasurer, there was a new assistant treasurer, plenty of time for them and their departments to review it. Finalized in sort of December, January, were quite sensible recommendations, more around actually what she was paid to do, the quality of advice. Is there better ways to give advice, and also the remuneration. You sort of second part of the question is, what's the government's appetite to do anything about it? It would appear very little. As I said, Steve Jones has seen that report. He's sat in on it. He's been on the whole journey. The very first thing that happened when he got it was he said, I think I might need someone else to do another review of the review. And I can only assume Michelle Levy must have been extraordinarily frustrated, because everyone saw the financial review a couple of weeks ago where she penned, and I've never, probably has happened before, I've just remembered, she penned an open letter to the Fin Review expressing her frustration that we've spent a lot of money as a community on this. We've had some incredibly smart people do it. We've had a lot of people look at it from all angles. There's one or two consumer groups that, frankly, they're never going to be happy. The beer's always going to be too cold, or the pies are always going to be too hot. They're never going to be satisfied, but they're as satisfied as they can be. And as her open letter said, I just don't understand what the delay is and why on earth. And she'd probably feel quite aggrieved about the fact of, and why you want to get another committee to second guess what I've spent a whole lot of time doing. So I actually don't see Steve Jones and Treasury doing anything. I am, as an insurance stalwart, I reckon the biggest stain on the insurance industry is a lack of affordability of insurance and a lack of accessibility of insurance, particularly in those nat cat prone areas. there has been a solution for that sitting. It went back to when Bill Shorten was Assistant Treasurer, way back in 2011. They've been sitting on a solution. Steve Jones's first 3 months in office, all he had to do was tick off that cyclone pool and migrate it more into other perils. Steve Jones says, I think we need to do another review of it. So I think what we've got is a government at the moment whose track record is we need to do another review. I just don't know how many reviews need to get done before we do something.
Let's just hold that thought, and I think we'll put a red dot on recording around 32 minutes, which is where it became slightly controversial and quite political. But thanks, David. That was very entertaining. Paul, just quickly, let's just suspend reality for a second. Let's assume that David's wrong and parts of QAR.
David's not wrong. He's right.
do just work with me here, Paul. Do get enacted. I'm thinking good advice, and promotion of funding of advice from super could be game changers. Vertical integration through the back door, maybe. It's been persona non grata for at least 5, 6, 7 years since FOFA. What are your views on that at a high level, of course?
Yeah, look, I think, again, at a very, very broad level, I think some of the things that that Michelle Levy addressed and was trying to answer was, the affordability issue, was in some ways trying to work out ways how they could make advice at the advice practice level more efficient, so it could be delivered in a much more, affordable way. And your point, Chris, vertical integration potentially is one way that could actually be delivered. Now, whether people believe that it's right, wrong, or otherwise, I'm not here to question the virtues of vertical integration or not, but that's potentially one of the ways. And to Anthony's earlier point, that would then potentially bring in, the re-entry of banks and other large institutions into kind of the advice world. So, it's traditionally where we've seen the most M&A activity in our industry has been when there's been disruption around the way that advice is paid for, whether advice is delivered, the complexity around, how difficult or otherwise it's not. So potentially, depending on kind of where this lands and where the review of the review ends up, that could absolutely spark another round of, active M&A.
Yeah, hope so. Nelson, what are you seeing overseas, particularly in the US?
I think the drivers we are seeing for our M&A, particularly in funds management, just to take a different angle here, is predominantly driven by more factors that David, you might have referred to around succession planning, the need for scale. How regulatory reform plays into that is obviously increasing the cost to doing business. And therefore that feeds in the need to be more scalable as a business or need to attain scale. So we don't often see, whilst certain regulatory reform does drive more M&A activity, a lot of the regulatory reform we're seeing in the sector is increasing the cost of doing business, the barriers of entry, and therefore scale becomes so critical. And I think that's been one of the major drivers at the bigger end of M&A, particularly in funds management globally. In Europe, there's a thematic going around, which is the $1 trillion club. Basically, mega mergers, big fund managers coming together to get to $1 trillion and become the next BlackRock type. And that's what they mean by scale. So that's kind of driving that. And we've seen, obviously the Pendle Perpetual deal, again, very much a thematic around getting scale in that deal as well, and cost synergies. So I think how regulatory reform plays in that is more about scale and technology, and as well to kind of, again, lower cost to service. So I think overseas, I think the other big thematic is less regulatory and it's more kind of a lot of dry powder and capital. So at the end of the day, it's supply and demand driven. And there has been enormous amount of capital, either from insurance-backed company or institutional type capital that is going into these sectors. So it is exciting because, these sectors and the business model around recurring revenue streams, sticky clients, long-dated revenue contracts appeals to that type of capital. So certainly, I know this is not a regulatory thing, but that's probably more driving M&A than, I would say, domestic regulatory change.
Okay, understood. Anthony, finally, we talked a bit about the government. What can we expect from the regulators in the coming period? And be very careful with your response. Right, next question.
Look, I'm not expecting any revolutionary changes from the regulatory side of things in terms of supporting M&A or not. You know, I think M&A is very often, if not always, driven by changing business models. Excuse me. And regulation is one of the key drivers to those changing business models. You know, regulatory cost continues to be a factor with all businesses, and I don't think, you know, those costs are going down anytime soon. So people need to find different ways of generating a return, and often that's through M&A and scale, like we've talked about. One thing I would say is that, you know, regulation has very much stopped cross-border banking transactions globally. You know, we just don't see that anymore. You know, the prudential regulators, not just APRA in Australia, but globally, you know, it's very difficult to justify owning banking licenses in multiple jurisdictions, because every one of the prudential regulators want to regulate not just your operations in the country, but the whole group. And I don't think that's changing anytime soon. So, you know, I'd expect that to be a barrier, you know, for the foreseeable future. Yeah.
Great, thank you. So let's, sorry, Nelson.
I was going to say, just to give one point of credit to the government in the area of housing. Now, that's probably one area we have seen where they've come up with tax reform, particularly in withholding tax around housing versus other sectors of real estate, and equalizing that from foreign investors coming in. So there are activity and regulatory reform, which I think is conducive to foreign investment, in particular housing. And obviously the government's very focused on addressing that issue for the nation. So we have seen steps in positive reforms in housing, and therefore that will drive activity, whether it be M&A or foreign investment, into foreign capital coming in here into particularly the build to rent sector. It's an area we've been working on more recently. And so we think there's a real big opportunity in build to rent, and you will see over time more and more foreign capital coming in. We've seen a lot of sovereign funds investing in that area, like GIC and others. So I think you will see that continue to grow. And I think there's a whole industry that can be built around that, the whole build to rent housing solution for the nation. Yeah.
Great, thank you. So let's change gears somewhat and talk about technology and fintech. So, you know, the buzzword at the moment is AI. And we've seen applications, if you can call it that, such as ChatGPT and other machine learning modules. It's been a bit of a boon for presenters who are looking for inspiration with their presentations and kids doing their homework, although I think there's been significant steps to clamp down on digitized plagiarism. But in terms of disruption, technology-based disruption in Australia, we've seen essentially technology companies disrupt the oligopoly that the banks and a few others held for some time over the platform sector. And robo-advice is heralded, maybe with the assistance of QAR, if that ever gets enacted, as the panacea for, or potential panacea for Australia's advice woes. So what I want to understand from the panel is your views on what the next wave of M&A will look like. Will it be predominantly focused on technology, or will we still be doing deals which are focused very much on fundamentals such as FUM, FUA, customers, distribution, etc., with maybe some less significant technology underpinnings? So will technology be the main focus, or will it be a supporting theme? And I go to Paul on that one in the first instance. Paul, just on robo-advice, is that something that you'd have room for in your stable, and or would you pay to buy a robo-advice solution?
So if we think about the history of robo-advice, particularly in Australia, it's littered with series of failures. You know, lots of capital, a lot of investors have put a lot of capital in it, and we haven't seen a real successful one yet. So why would that change now? And the answer is, you know, AI technology is changing. There's reasons to start to believe that eventually someone will get it right. And I think one of the reasons that it's failed historically, apart from the tech piece, is they haven't been able to access and get enough revenue or get enough clients in these models that they've built. So the interesting part, Chris, is around, does Robo have a role to play inside or next to an advice business? Or will Robo forever be a competitor to advice? And the way that we've started to think about it is it absolutely has a role to play within or next to advice practices. So for us, the two roles that we see Robo/tech playing is we want it to absolutely sit behind the advisor in the advice delivery process. So we just see it as another tool that advisors can use to help deliver advice more efficiently. So that's part A. But the second part is to act as an incubator for future clients. And I think where you have particularly large scale firms that have access to not only clients, but kids of clients, potentially a robo solution makes absolute sense to have within your stable somehow. And for us, topical question, probably in the last 2 or 3 months, we've really started looking at a couple of the players that they're really struggling to actually get traction, but they've got the foundation for something that could potentially be very good. So for us, it's a question of, is it something that we build ourselves or is it something that we acquire? But I think if you just close your eyes to it totally, I think, over a long, long period of time, you're going to do yourself a disservice.
That's a good point. Well made. Nelson, you mentioned technology earlier in response to one of the earlier questions. I think there's a perception that in a lot of areas we're at least 6 months behind the maybe longer in the market leaders in particular initiatives, including fintech and other technologies. What are the themes in the US, noting that the Berkshire annual report, which I've read, which is excellent, includes a lot of deals across several sectors in which you operate. What are you seeing in the US in particular?
Yeah, if I could summarize without going to the specific, obviously there's an incredible boom now. After crypto and blockchain kind of had a false start, and there's a lot of focus now on AI and what that means is the implication of that. And I think even as yesterday, I was speaking to our fintech team in New York. They're saying they can't keep up. Now, what was new last week is no longer new this week. And so there is a lot of development, a lot of capital and ideas being put into it. The way I would look at it from an M&A, from a sector perspective, is really about breaking down and solving two challenges. One is information asymmetry and access asymmetry. So the first one is really about, can AI level the playing field for information asymmetry? Whether you're a client, you're an investor, you're a fund manager. So you'll find that a lot of what this AI is trying to solve for is leveling the playing field for information asymmetry. The second one is access asymmetry, meaning, if you're a retail investor, you can't access certain products that an institutional investor can or a bigger investor can. And you kind of saw that play out in Australia with SMA. Once upon a time, IMAs and SMA were really for high net worths and big clients. Now a planner can produce an SMA product for a retail client. So that's access asymmetry is what I mean by that. And I think where the next target is going to be around accessing private market products, products that once upon a time you can only access as an institutional investor. And how will retail investors access that? So a lot of technology and this technology business model, when you look through it, is really at the end of the day trying to solve for one of those two things. And SMA is a great example of how technology gave retail access to something once upon a time was only available to a certain segment of the investor market. So that's probably two ways you can look at it. And there's a lot of noise, there's a lot of buzzwords, but if you kind of bring it back down to what is practically these technologies would deliver to your clients or to your business, typically falls in one of those buckets.
Right. David, over to you. I think 5-10 years ago, technology buzzword in insurance, it was all about telematics. and how you sort of really zeroed in and fine-tuned pricing at the individual level. Now, I think there are arguments that taking that approach would sort of break the traditional insurance model. So I don't know whether that's as hot as it once was. But what are the most recent technology themes in insurance which could have a transformative effect?
Yeah, I think on the insurer's side, on the underwriting side, a lot of the investment is made around risk rating. So telematics, at the end of the day, it was a tool that you put in your car and it could track your kilometers and how you drove and everything else. So it was trying to refine more around risk rating. The challenge is at the heart of insurance, and insurance lives and dies by the pooling of risk. You know, at its most fundamental, even if I've got to explain to a bunch of 10-year-olds what insurance is, you all put in $100 each, and if something goes wrong with one of you, you take all of the money out of the pot. So insurers can really refine, and they've invested an extraordinary amount of money in things like telematics, but it never really kicked on. I think the invasiveness of it and how the hell do you really use the data when you're trying to go against pooling never really worked. Same, you know, with a lot of the peril-based rating, there's only so far you can do before you just start individually rating someone, and that's not insurance, that's not pooling. So I think insurers have pulled back. I think a third theme on insurers' side, and I lived and breathed that, there's not enough return for taking the risk in an insurer to be entrepreneurial with technology. You're dealing with these really old clunky legacy systems, and you know, even if you want to be a tad entrepreneurial, if you make that mistake, my God, it's just not worth your career. And a lot of the people in insurance companies are living and dying by their careers. So the bounty's not there. On distribution, it's been quite interesting. I've really enjoyed coming in distribution. The PSC model, back to acquisition, we are 100% unashamedly buying client bases, recurring revenue streams and people. We have no ambition to go buy big tech. It's something that I sat down with our CIO on and spoke to the board about. Owning your own tech end to end in insurance, in broking, could actually be I don't think there's almost an anchor around your neck. It's very tricky. Our view is that we will always use technology and we'll leverage our scale and we'll bring people in. And that's a great thing about having, you know, 20 branches in Australia, 2 in New Zealand, and, you know, 200 agents that we're the sort of licensee for, is that we invest in our technology, but in a really judicious way. So we're an SME broker at heart. Most of our clients are SME mid-market clients. A lot of the transacting of that SME, like we need to, you know, talk to them face to face, talk to them about their risks and simplify insurance for them. A lot of our transacting is done with our major insurers. But one of the things that we find is that, you know, you've got to get a quote off a major insurer, you've got to key in information to, you know, company A, company B, company C. We've invested a fair bit of money in robotics to do all that for us. So you key it in once, the robot sees what you've done and they replicate it over multiple insurers. Then what we do, of course, is that every insurer has nuances in their wordings. Now we're investigating using AI for that. As I was saying to, you know, our CIO, if a university student can say, write me a thesis on, and the machine can go find that and it's as good as they could ever do themselves, surely we can ask the question, tell me the difference between Allianz CGU and QBE's BizPack policy. And surely, you know, going to a database that can come back and say, yes, QBE will offer 5 million limits here, Allianz 2 million here. So that's our next investment in the next 12 months. That's the great thing about acquiring businesses. You get scale and then you can reinvest in it. We have a very simple saying, you know, to us, if we're going to invest in technology, it's got to provide operational efficiency and improve the customer experience. And invariably, when you're providing operational efficiency, our brokers, the paid advisors, they've got a choice of what they do with their time, but hopefully they're going out there generating new revenue, talking to their clients about something else, etc. So
very
that's
interesting.
how we use that. That's tech for me. But the thing is that I don't think we'll ever own an AI company or we'll ever own a robotics company, an RPA company. And certainly as we start building direct links into the insurers versus API, we won't own API companies. There are so many smart, young entrepreneurs in Australia. And my God, I met one of them down in the Docklands, and he's just a young consultant. He'd be in his mid-30s and he got onto this robotics things about 5 years ago. And I said, with what we're going to invest in you to help you get there, we're going to turn you into an extraordinarily wealthy man because you're going to get some great IP. But him and his team are just inspiring how much, and they're so passionate about it. So that's why I'd love to own him, but I'd be worried that if you owned him, you don't get that same developer.
Hopefully he wasn't impacted by the implosion at Silicon Valley Bank. But Anthony, just to round this discussion off, interested in your views, particularly around whether there's a global platform consolidation and who might be involved in that. Is it financial services companies or is it big tech?
Yeah, I mean, I think technology is in every M&A deal. I don't think you can say that technology is really driving anything. I mean, any company, whether it's a bank, insurance company, asset manager, wealth player, technology is really at the center of diligence. And that's one reason why we're seeing less, I guess, aggressive takeover, much more friendly takeovers, because people actually do need to do diligence on the technology. People aren't willing to take the risk on, taking it for granted. So, that certainly is driving some of the way M&A is done. But, I think in terms of, Paul mentioned it before, one of the key reasons, for M&A is capability or buying capability. And I think the questions that companies ask themselves whether to buy or build technology, quite often, is the reason for doing M&A. I think the emergence of AI and, this fast moving technology is really put into the question rent as well, because, I think people don't, the obsolescence of technology is a real thing. And, we're seeing much more, do we buy, build or rent the technology? And I think that's certainly becoming, much more prevalent.
Steph, thank you for that. Conscious of time, one final question from me, and then we might move to any questions from the floor. Foreign investment, clearly Australia is hungry for capital. We've seen our stock of foreign investment coming from Europe in banks and funds management traditionally, from the USA into banking, from Japan into life insurance. But I think it's fair to say that Australia has been a hard nut to crack. It's a tyranny of distance. We saw foreign banks exit with the tails between the leg post GFC or during the GFC. So just questions to the panel: where do we think that the next round of significant capital investment into Australia will come from in light of economic conditions and geopolitical conditions? Which countries will be the most interested and resilient? And I might start logically starting with Nelson, given the international dimension to the Berkshire business. What are your views on that?
In terms of what we're seeing, starting, say, with Europe, I think we'll see less capital coming out of Europe. We definitely, from the deal flows that we're looking at, majority of capital is coming out of the US. And that's partly, in the private equity sector, there's a lot of dry powder that has been raised in the last 2 years. So they definitely still have a lot of capital. In the strategic buyers, definitely out of the US as well. One of the reasons I think less out of Europe is a lot of the strategic buyers in financial services, whether it be funds management or wealth management, is this perception, or maybe it's real, that we're behind ESG. So we have seen deals where buyers from Europe will walk away because they will not risk doing a deal in Australia if it meant that that particular business could damage the global brand around ESG. So and you can imagine these companies have invested a lot of money and time in promoting the ESG brand. So they will be a lot more sensitive about, and partly they got their own problems. So I think, less out of Europe, more out of the US. I think in Asia, more out of Japan. I think there was a recent speech by the president in Japan and he gave a damning criticism of the Japanese funds management industry, which is quite rare for them to be public about that. And he was basically saying that there was a slip at the wheel and not diversifying, globalizing enough. So I think that's a tipping point for Japanese capital to be. They've been pretty active in the last 5 years, but I think you can see increasing amount coming out of that. I think India is growing versus China, but I think capital is still quite controlled. So I don't think you see too much of that out of India. China, obviously politically sensitive, but the government is quite, I think their capital would tend to go to the US, despite the politics at a commercial level. They're actually quite cooperative. So, but from Australia perspective, probably mainly US.
Yeah. Okay. Interesting. Anthony, does that chime with you as well?
Yeah, no, that's certainly what we see. I mean, I guess the other point to that is the type of capital that we're seeing at the moment, not just the source of the capital. Certainly the trends we're seeing is the type of capital investing in companies or taking them over, taking them private, is coming from that either pension fund or private equity space. You know, traditionally we saw a lot, 20 years ago coming out of Canada and the Canadian pension funds. You know, the rest of the world caught up a little bit on that, including Australia. We're seeing a lot more direct investment out of these big super funds. And, given the huge amounts of cash private equity is sitting on at the moment, we're seeing that type of international capital come to Australia. And that's really a bit more patient capital. And we're seeing a lot more companies taken private because investors, where companies are trading at the moment, it's not really fundamental value. And, there is, in private ownership, you can be much more patient and have a longer term objective. So yeah, that's certainly a thing we're seeing.
Yeah. Okay. Thanks, Paul. Just quickly, we're seeing, I think, a lot of US investment into the wealth sector, and that probably would have been inconceivable 10 years ago. Why is that, do you think? And is it going to continue?
Yeah, it's certainly new for us. So we grew up watching particularly PE and US money flooding into Australia, doing deals in other bits of the wealth sector, whether that's asset management, fund managers, or even platforms. And I think if you think about the last 10 years, about where we've seen fee pressure, so forget about margin, but just fee pressure. You probably haven't seen a platform provider put their fees up in the last 10 years. They're coming down. You haven't seen a fund manager, very rarely, put their fees up. So the last bastion in the chain essentially is advisors. And if anything, in the last few years, we're actually seeing really good advice firms actually increase fees. So over the last 10 years, where we've seen this flood of money come into the country and it's concentrated in other bits of the sector, I think there's two reasons why they're now starting to look at advice. And Nelson and Anthony in particular, given the work they do, would have seen this and a better place to validate. But I think the reason that we're seeing it in the advice sector is twofold. Is one, revenues are solid, sustainable, repeatable, and actually growing. And secondly, the industry is maturing, and the types of funds that Anthony spoke about before who are coming to Australia, they would only ever be able to do micro deals. And those deals were way too small for some of these firms. Whereas now we're starting to see the emergence of corporatized firms, larger firms, and that makes the investment proposition, because they're looking for businesses that can go through many, many cycles, who don't have to go through succession issues, who can still be standing up in 5, 10, 15, 20, 30 years time as standalone businesses. So I think those opportunities today are here for them that weren't historically. So yeah, absolutely, Chris, we're seeing more and more of that capital coming to Australia, looking for a home, probably for those two reasons.
That's great. David, I'll not pose that question to you, because I know in your opening question, you gave us a sort of very good overview of the investment landscape, who the players were, both domestic and international. What I might do is look to Jacob and see if there's anybody in the audience who has a question for this excellent panel. Who's going to ask the first question? Jeff Lang.
Jeffrey Lang from UI. I also work in transactions as well, and probably been across the table from a few of you, or on the same side also. A question really directed more towards Nelson, maybe Anthony also. You talk about technology and due diligence increasing importance. Of course, we're seeing a lot of take up on cyber as well. What about data? What sort of requests are you getting from your clients around due diligence on the actual data that's used within your organization, the controls, the access, the quality, and how that data is used for commercialization aspects or analytics as well? I appreciate your insights there.
Yeah, why don't I start? Yeah, really good question. I mean, I think there's a couple of different angles for that. Certainly, I've seen a big change in how companies diligence other companies, particularly around big data. So, you know, there are tools and software now that you can use that makes diligence far more efficient. You can, you know, go through, you know, thousands and thousands of lines of spreadsheets or loan books or leases or clients, you know, and actually check every single one of them, where, you know, you would never ever be able to do that in the past. So certainly you know, when we look at data and security of data and, you know, the credibility of the underlying data, certainly diligence is very much focused on that. And I'm, you know, currently seeing different tools being used to actually, you know, ensure that that's properly diligenced. Yeah, and then I think probably going a little bit further, you know, what are people worried about when they're doing diligence? You know, cyber and data security and breaches is, you know, if it's not number one, it's number two in every single deal. And, you know, that's actually being baked into contracts in terms of material adverse change clauses in contracts. You know, I haven't seen one in the last 5 that hasn't got some sort of cyber MAC in the contract. You know, so it's certainly at the front of people's minds. Yeah.
Yeah, I think I'll just add to that in that I think what we have seen is buyers also utilizing experts a lot more, recognizing neither the seller or the buyer are kind of up to speed with this. So everyone wants to get to best practice. And so unless the buyers are very experienced, they are typically outsourcing that due diligence to experts in that field. The other thing I would say is, particularly when they look at some of the Australian companies, they know Australia is somewhat behind maybe global standards and best practice, particularly in cyber and even now privacy protection. So there is expectation that in M&A that the buyer would potentially bring some value in that regard to help the target company they're acquiring to lift that standard as well. So I think there is light in the tunnel in that they're not expecting every target to be at best practice. There is a recognition that the due diligence is actually identifying what the gap is. And therefore, as part of any transaction, what they may need to do to lift that standard as well. So, you know, I think there's a fear that, oh, we're not up to scratch. You know, what does that mean? I think people are realistic in terms of what that gap is, particularly if the buyer's coming out more the US world, where they're way ahead of us in policies and protocols. Yeah.
Thanks for your question, Jeff. I think, Adrian, you had a question.
Yeah, no, it's a good question, and you know, I think it's relevant in the times of AI, and you know, what can be replicated outside, you know, people contact. Yeah, look, we've been around for 2 years. We've got 350 people. We've grown to, and primarily we've built a business that now we're number one across most of the product sectors in the Australian market, and that's 100% because of people. You know, we've been able to attract you know, the leaders in all of the fields, and they're people with relationships, you know, that have been, you know, it's a new firm, but we've got people that have, you know, had experience over 20, 30 years. So, you know, I think the advice game and trusted advisor, and, you know, it applies to Paul as well in your customer base. I mean, I think you can't replicate that. And it certainly is the differentiating factor, I feel, in, you know, when, if you're advising a board and something goes wrong, you know, people still want to look someone in the eye and get proper advice, you know, live. Yeah.
Just thanks, Anthony, and for the question, Adrian. Just a final question, which is, I don't know if it's an anti-Dorothy Dixer, so the opposite of a Dorothy Dixer, but the tide goes in, the tide goes out, and history has a habit of repeating itself. I remember the very last deal I did in the UK 22, 23 years ago before I came here was to acquire or advise a client who was acquiring the global consulting business of one of the big four accountants. And I may or may not be looking at Jeff when when I mentioned that historical factoid. And then there was a sort of reference, one of you guys picked up on it earlier, there was a reference in one of the papers or trade press 3 or 4 weeks ago about how big banks or a big bank might be looking at dipping its toe back into wealth management, depending on what happened over the next year with legal and regulatory reform, etc. What big question coming up? What are your predictions for the future? Are we set for a reset in the next 5 years? What do we think our respective sectors will look like, or subsectors will look like in 5 years' time, with a particular eye on deals, which is why we're here today? Paul, can I trouble you to answer that question on wealth management? Save the best for last, mate.
Yeah, that's a
Big question.
look, very, very quickly, a very, very high level, I think. The banks absolutely will be back into wealth. Absolutely, within the next 3 to 5 years, they will, to Anthony's point earlier about, you know, what's happening in their businesses. When they look at our industry, when they look at sort of the advice industry, there's absolutely reasons, great reasons for them to sort of re-enter. What that means for the sector as a standalone, on a standalone basis, my earlier point, I think the small boutiques will absolutely continue to flourish. The bigger scalable firms will continue to get bigger, and then the middle ground is the real battleground. The middle ground is where all the pain points and the change is going to happen. So it'll be very, very polarizing. I can see sort of, you know, in 5 years where that middle ground basically either goes left or goes right.
Okay. David, same question, insurance.
On the distribution side, I think there'll be a lot more aggregation. I think it'll get really interesting in 4 to 5 years' time. In the Australian market, at least, there's 3 listed insurers. So there's plenty of room for activity there and a lot of capital coming from overseas. So on the distribution side, I can see it. And I think distribution's been, you know, flavor du jour, if you like, for a lot of investors, because they can take the, you know, they can take the margin of insurance without volatility. I think inevitably, I don't on general insurance, I don't see banks, large banks, ever wanting to get back into it, not for at least the next decade. I think there's enough of them that have worked out that we just can't be asked with all these catastrophes and reinsurance programs and all that stuff. We've got a client base, we're just better off auctioning that off and taking the distribution margin would be my guess there. I probably see a little bit more of a wave in aggregation M&A, if you like, probably more at the mutuals in Australia. We've got some quite large insurance mutuals, mainly the old motor clubs. I just think that that's going to get trickier and trickier for those guys, particularly because catastrophes aren't going anywhere but more volatile. I mean, it's fact, you know. So I can just see some of these mutuals wondering if there's a better way for them. Again, they've got a client base. Do they want the balance sheet risk? So I could probably see something in there. But outside of that, I don't, you know, maybe there's the odd insurer that always gets speculated. But yeah, as I say, I think banks on insurance, bank broking, more aggregation, banking no-go into general insurance for at least the next decade. But mutuals, I think, will be interesting to watch.
Interesting. Thank you. Nelson, funds management.
I actually put that question into ChatGPT. And the top #1 response from my AI is the prediction is more AI, which I thought was pretty interesting. As there's an old Chinese proverb, if you ask a Chinese plastic flower vendor if his flower smells nice, the answer is yes. But I think the second one was interesting. He actually said comprehensive retirement income solution, which I thought was an interesting one, because, you know, the one thing within funds management that fund managers are not focusing enough on is this idea of decumulation is increasing as a proportion over or super pie. So superannuation is growing, as we all know, but decumulation, because the baby boomers and the government talks about 5 million people going to retirement and there's not enough advisors. But I think from a fund manager's perspective, most fund managers were born servicing accumulation. So a lot of their products are equities based and others, and it's really about geared towards helping you accumulate wealth. And we've got products in the accumulation, but just not enough. So I think the big 3 to 4 years going forward is fund managers looking for solutions, maybe capital stable yield, M&A and buying capability that addresses that for them, just service that segment of the market. So maybe the AI is right.
Okay, good. I don't know how you got hold of these questions. There must have been a leak, which I'm going to look at. This was all spontaneous and off the cuff. Anthony, let's draw things to a conclusion. Your predictions, the biggest one, I think, on the banking sector.
Yeah, look, I think as we go into the next sort of 3 or 4 years, we've got to look at the backdrop of interest rates and geopolitical mood. I think that will drive a lot of M&A activity across the banking sector. There's not a lot of, the major banks are not going to merge with each other. I think I can be certain of that. But certainly, the future of regional banks in Australia has a big question mark over it in terms of, are they investable businesses? They can't seem to return their cost of capital at the moment, and I'm not sure that they will ever be able to do that. So, yeah, look, I think the interest rate setting is going to expose quite a number of business models, and that's going to drive M&A. Yeah.
Good stuff. Well, gentlemen, thanks very much for taking part today. I've learned a lot, and hopefully the audience has learned a lot. I was writing notes furiously in completely illegible handwriting because I was hoping to sort of pull it together into a pithy summary of what everyone said. But fortunately, Angela here, I think, will do that job for us as our sort of in-house journo. We've been sort of circulating some very good summaries of these sessions throughout the week. So thank you for your participation, and thank you everybody for coming along today. Everyone who registered, I've got a note here, everyone who registered today will be sent a recording of our previous sessions, and that will include contact details for folk who were involved. So if you've got any questions, don't hesitate to get in touch. At lunchtime today, we're continuing this series with a webinar that will examine insurance considerations for AFSL holders. I think that's you, Phil. I'll be tuned in. Make sure you're all tuned in for that. And tomorrow we're finishing off with a webinar, I think, relevant to a point that you just made, Nelson, about decumulation and longevity, which Anne, I think, is Anne still here? She's Anne McNamara, very experienced superannuation partner. We'll be talking about how super trustees can help their members to meet their retirement income needs. So that'll be very interesting. So if you'd like to register for the remaining events, please do so. You can speak to Brielle or Brielle's on a plane. So maybe speak to Jacob and Angela at the front here if you want to register. That just leaves for me to say thanks again to the panel. And thanks to everyone who's attended. I hope you enjoyed it.